If you think of 2022, through the first 3 quarters of the year, and we're like you said, 3 days away from the end of the year. So hopefully by the time this airs, I'll maybe slip you the full year's tax savings results. But the tax savings we've delivered through September for our end clients is a tax savings of 2.99%, which is kind of higher, if you think about it, than what we actually produced in 2020 for the entirety of the year. Our 2020 results were 2.58 versus 2.99 through the first 9 months of the year. And the last quarter of this year hasn't been any less volatile than the beginning of this year, right? So we likely will add to that result.
Welcome, Model FAs. David DeSell here, president of Model FA and your host of the Model FA podcast. And we have a guest today that was actually an introduction from a good friend of mine, Nick Gukin. So Nick, if you're listening to this episode, which hopefully you are, I just want to say thank you for introducing us to our guest today. And just goes to remind everyone who's listening, if there's an advisor or someone else that you think would be a great guest for the show, we're more than happy to be introduced to them, chat with them, and see if they could be a good fit. So feel free to email me at david@modelfa.com and happy to have a conversation. But with that being said, I want to introduce Hiren Patel, who is the head of advisor solutions at 55 IP. And today we're going to be talking a little bit about what their service model is, as well as sort of an industry outlook and some strategies that advisors deploy into their business. But Hiren, welcome to the show.
Yeah, thanks, David. Thanks for having us. And Nick, if you are listening, thanks for making this introduction to David.
Awesome. Well, give me a sense and our listeners a sense of your background, just so we can kind of help set the stage and get to know kind of where you started and ultimately how you ended up as the head of advisor solutions at 55 IP.
Yeah, absolutely. And David, I think one of the things that I'm really proud of is, I actually started my career in the seats of those that I actually serve today, which is a financial advisor, right? I got my break as a financial advisor with Merrill Lynch. And very early on, I felt extremely comfortable with kind of that sense of the model portfolios business. And, if you think about it, Merrill built the portfolios with the best and brightest in the room. And I honestly felt comfortable talking to as many clients as physically possible at that time. So, for that reason, I was kind of what they would consider a super user of their models-based practice. And, so much so that when they launched a managed account solutions team, I was asked to be one of the first to kick off that pilot. So as kind of time went on and Merrill launched more strategies with a tech-focused platform, so you think of kind of the self-directed platforms or the robo-advising platforms, I was asked to start sharing with FAs how those technologies could benefit their business. Now, I'm talking, don't get me wrong, I'm talking, 10, 12 years ago, before FAs were even comfortable with the word technology being walked into their business. And I remember once there was an FA in the New York office where, he asked me to shut my door behind me. And then promptly, I remember him pulling out the Wall Street Journal article from Merrill saying, $5 trades, what is going on? And those weren't the easy days. But I think the one thing I did learn was the key to kind of unlocking a partnership with advisors is demonstrating value, right? Putting money in their pocket and putting time back in their hands, right? And Merrill was, exceptional when it came to training in regards to practice management. And it became clear to us that helping kind of advisors, get in front of us, get those at-bats with us as a practice management consultant really simplified their lives, but not just their lives, right? There's CAs, there's associates that are built with a team, and we try to make their lives simpler and kind of get those book conversion conversations with branch office leadership. So we started to realize that touching multiple lines within an advisor's practice started to actually make, progress forward. But I kind of knew that tech was kind of the only way forward in the wealth management industry pretty early on. I kept trying to seek out firms who had deep roots within the wealth management and kind of that fintech space. And I wanted to marry kind of the two with my next jump. And I joined a firm called SigFig. And if, there's folks that are out there that are unfamiliar, SigFig is a leading Silicon Valley firm, which kind of had deep roots with Wells Fargo, Citizens Bank, UBS, Santander, Scotia, and kind of that list goes on and on. But what they did was they provided a white labeled end-to-end account opening, account funding, compliance review tool, all within one. And then once that account was established and open, they basically went ahead and managed that model portfolio for the FA. So I'm kind of still in that model portfolio business. And when I say kind of practice management, I think, I was remembering the times where we did case studies with advisors and we said, we're helping you break down your 2-week account opening process down to 20, 15, 30 minutes. That's where you start seeing the impact that kind of practice management technology starts to have in an advisor's practice when they get to speak with more clients and clients have better interactions with their advisors. So I started getting this taste of the large financial institutions like the Merrill, the Wells, the UBS, et cetera. SigFig also started touching the bank channels, but right around that time of 2022 and COVID, I began to notice kind of a shift, which was happening where many career financial advisors were starting to kind of move towards that independent or the RIA channel. And what was kind of becoming a little bit more clear to me was the technology was beginning to kind of take shape more, aggressively and faster in areas where there were less barriers to entry. So you kind of think there's not too many steps to introduce technology into a home office, if you will. So I started speaking with, a friend of mine who happened to be at 55 IP and understood kind of the firm's mission was to be that industry standard for tax smart investment management. And they were doing it while joining forces with the asset managers as their partners, and then reaching out to the financial advisors where they actually do business, which was with those asset managers. And kind of that was the key. That was my aha moment in which I kind of knew joining 55 IP would blend, this practice management background that I had with this advisor distribution experience, kind of that I had, along with what 55 IP was doing, which was having this fintech culture, but also a leverage distribution model that I didn't have kind of where I was previously. So for the better part of 2022 and rocky, if you will, 2022, it's been in this tax management space that I'm in now. I've been with 55 IP as the head of advisor solutions, where my job is to really demonstrate value to our advisors, demonstrate value to their clients, and ultimately kind of demonstrate value to the industry. And I do this, I say, in 3 ways, right? I try to lead, the communication and conveying the tax smart technology's value by running analytics. I produce the tax savings results for the firm. We build with our marketing team. We write blogs and content, white papers, et cetera. And then joining webinars for industry conferences, or simply joining podcasts, which touches FAs in the audience, like the Model FA podcast that you host, David. So that's kind of me in a nutshell, if you will, taking you through my journey.
Love it. I appreciate that. It's always interesting to see how often there's advisors in this industry that are advisors for a number of years. Throughout that journey, they either experience themselves or see a potential problem or opportunity, and they end up leaving that traditional advisor role and going to solve that problem, which I really like, because it's not people kind of theorizing how the industry can be better and then coming in to try and serve the industry. It's someone has experienced how it could be better and then just branches off to serve more advisors. I really like that shift that I see with people getting involved in companies like yours as support advisors.
Yeah. And listen, I've said this a few times to financial advisors in the past. And I said, listen, if I had technology back in the day when I was an advisor, I might have not left that lucrative job of being an advisor.
I get that.
Yeah.
Before we get too far, though, I know when Nick had originally made the introduction, I wasn't familiar with 55 IP. So to save our listeners from having to pause the podcast and go, get some context, as we continue to chat, can you share a little bit about what 55 IP does and the technology that it provides, just so we can set the stage a little bit more?
Yep, of course. So 55 IP is what we call a tax smart investment strategy engine. And essentially, we're a fintech company that empowers financial advisors to deliver customization at scale. In my opinion, 55IP is kind of one of the leading technology providers, which offers kind of this combination for financial advisors to blend user experience and model delivery kind of at an exceptional scale, right? That advisor-led experience, which we've launched, is very simple. It's very intuitive on the front end. We then kind of use technology intelligence to kind of occupy that middle for delivery of trades, et cetera. And then on the back end is the generation of the trades and the execution of the trades. So what we're trying to do is, with our platform is to make it very easy for financial advisors to incorporate their own investment views, reflect on what a client's needs and values are, and then deliver really that staple of a personalized tax management experience through what we call active tax technology. And I think I mentioned this before, but our mission is to be the industry standard by offering tax smart technology across all assets and all client types within the wealth management channels. So we're not just serving, large multi-million-dollar accounts. We're also serving accounts, that are all the way down to, what mom and dad would potentially have at that point, right? And, when advisors typically hear technology, they think of the words, technology stack, or I got to rip and replace. And we're actually doing neither of the two. What we try to do is we're supplying a technology infrastructure that's essentially integrated with model providers, and it's already integrated with custodians to kind of make that advisor experience a lot simpler than trying to figure out whether they want to or need to rip and replace something with what they are already doing today. And in terms of our client base, our clients are primarily financial advisors, they're RIAs, they're large aggregators. And today we work with somewhere around 200 firms that oversee, north of $100 billion in discretionary assets for their clients. And typically we reach these advisors through what we call key partnerships. Some of the partnerships are with asset, manager providers. So think of BlackRock, JP Morgan, Fidelity, Wisdom Tree, Riverfront, and a few others, for example. And then what we do is we try to enhance that practice management experience through deep integrations with actual custodians. So think of your Fidelity, Schwab, and TD. And then we're starting to branch into the broker-dealer space as well with our current partnerships with Janney and Baird. And we, again, have access to their several hundred financial advisors within that channel. So our real focus is on who we serve and kind of how we interact with those advisors to give them that scale and efficiency to be able to deliver a portfolio to their client, do it in an easy technology, and also have that technology be fully integrated rather than a rip and replace technology stack at that point.
And earlier you mentioned that which I agree with, right? Over the last handful of years, there's been a shift from some of these larger firms over to the RIA space, be it starting their own RIA or joining another smaller RIA and kind of growing together. And I see that there's also a shift kind of back in the other direction where they're joining larger RIAs now if, they went out on their own initially. And I'm curious to know, just to sum it up in a short phrase, with your guys' tax strategy, how does that coincide with some of the challenges that advisors face when they are in the midst of changing firms or articulating their value proposition to attract new clients? How do those two things intersect?
Yeah. And, you nailed the kind of shift in the landscape, head on, right? There's advisors that are looking, post-COVID, let's say, I can do my job anywhere, right? You're looking to go ahead and move from a large firm independently, but then that realization quickly happens that, I don't have all the infrastructure that I need to do the job the way that I was doing it and to deliver the value that I was delivering previously. So there is this kind of a shift back, very quickly, a shift back from the independent to the RIA aggregation space. So yes, the landscape has kind of shifted quite a bit. The advisor trends are moving more from commission-based to a fee-based practice, right? That's another thing that's happening. There's the use of model delivery. I think Cerulli, in the recent study that just came out late this year, expects the model business to grow to somewhere near $7 trillion. And then there's also this shift in direct indexing that's happening, which Cerulli also said in their recent report, which is scheduled to grow to nearly, I think $800 billion in a few years, 2025, 2026. And some big demographic trends also are starting to happen now, right? With the changing or the aging of populations, you're looking at a shift from savings to spending, right? That decumulation phase. And, although these are great trends, we kind of categorize all 4, 5, 6 of those items in something that we call money in motion, right? This is allowing an advisor to put a better solution in the hands of their clients while doing so to go ahead and shift the way that they're delivering the business right now. So, that's all great, but the immediate friction that, shows up when trying to get, the client into that better solution is the friction of taxes. The decision isn't just in the hands of the client who's responsible then for paying the taxes, but it's also then a focus on the advisor. And more so now when clients are very much in tune of what's happening in our industry, there's a requirement for the advisor to actually provide a creative solution in order to go ahead and make that transition or that shift happen. So when we think about tax management, it's really 3 things that we focus on when breaking down kind of that barrier to financial progress. The first is tax smart transitioning. How do we get a portfolio from one place to another place so that the client is in a better position in a tax smart way? So that we've created kind of this technology that can be leveraged by the advisor to, layer on the algorithms that we've built and to give them an intuitive experience in order to make that transition possible, to build portfolios and proposals then to deliver to their clients in a way that we are helping the advisor execute. So we do this kind of by matching up clients' tax preferences. We incorporate kind of their tax budgets, if you will, short-term, long-term, state and income taxes, et cetera, and basically try to match up the gains from their legacy portfolio that have been in existence for a long time, and also start to introduce a set of new positions for this new model that the advisor is looking to introduce. And as losses are generated in the new model, we will then use that loss to go ahead and offset gains from the legacy model to ultimately kind of transition the bucket down from the legacy portfolio and transition the bucket up for the new portfolio. So that is what we consider tax smart transitioning. The second thing that we try to do is, a lot of the things that we hear in the industry today is automated tax loss harvesting. Once a client is in the portfolio, we automatically monitor that portfolio for changes, and we're doing ongoing tax management in the form of tax loss harvesting, for example. So, what we're trying to do is we're also trying to mitigate that tax bill on an ongoing basis for when those rebalances and those clients' needs do end up changing with a model portfolio shift to reduce or increase their equity or fixed income allocation. And the last thing that we do in kind of that 3-legged stool is, we do tax smart withdrawals. So when it's time to get money out of a portfolio, we're helping advisors figure out how to do it in a tax smart way so that they don't have to keep big piles of cash on the sideline, or they don't have to, cause unintended tax consequences by, pro rata selling off $20,000 of a $2 million portfolio, which may end up incurring some realized gains at that point. But, by removing money, you have kind of this pro rata experience across the portfolio so that, what we do is we try to take that tax smart balancing of the portfolio and we incorporate kind of ourselves into the advisor's practice so that they can demonstrate the value in terms of clients, transition management, tax management, and withdrawal management. And I think, again, we can all say it's hard to save money and sock money away for the rainy day or sock money away for retirement, et cetera. That's actually the easy part of investing, right? That's the easiest part of investing, because what happens is when that money accumulates, the harder part of that entire process is trying to get that money out and doing so in an efficient or a smart way. So our overall goal then is to try to increase that practice efficiency, increase effectiveness, try to do so in a tax smart, not just for the models business, but also that SMA business that we support as well.
And it seems like too, based on the fact that it's a program or a technology, if you will, it saves a considerable amount of time, even with putting together that thoughtful plan when it comes to execution.
Yeah.
I think it takes out not just save time, but also the opportunity to eliminate human error as well, because they can be fairly complicated. But, I'm curious to know, so this past year, because we're recording this in between Christmas and New Year's right now in 2022. So this past year, let's just call it, the market's been a little bipolar or operating like a roller coaster. And, I've seen articles and, studies and blogs that are fairly polarizing from one another. On one side, you get folks who think that the juice isn't worth the squeeze when it comes to tax loss harvesting. Sure. And then you have another camp that says, it's incredibly impactful. What's your, I guess, personal take on that? And what would you suggest advisors subscribe to in terms of methodology around it?
Yeah. So again, very much a roller coaster year. If we think about, where we started to where we are now, I kind of also want to bring into perspective another volatile year, right? So if you look at, 2022, the Wall Street Journal had deemed it the perfect year for tax loss harvesting. True, right? We did have significant drops in the market between the months of March and April. But the massive swing in that market took all of 45 days, right? And many advisors kind of listening today will also, be quick to acknowledge that they likely did a significant amount of harvesting within that very short or very small window. But, when you start to take a look at that small window of 45 days, there also lives this interesting rule defined by the IRS in Section 1091, which says loss sales occur when a sale of a security happens with a loss, and that loss is captured within 30 days before or after the sale when you buy a substantially identical security. Now, this becomes kind of that tricky part for advisors, right? It's one of those areas where there's a very fine or delicate line that needs to be danced on. And when you think about it, a client just doesn't have one stock that you're going to sell, to go ahead and lock in a loss or a gain and then try to rebuy anything. There's dividends coming in, and there's, cash withdrawals, and there's contributions, and there's all kinds of stuff that are happening. And technology has made it easy to have cash show up and the funds reinvest automatically. But what now happens is that, your one stock is still one stock. But behind the one stock, there's 10, 15, 20, 50 lots, of that same stock position. And this becomes a bit more cumbersome when advisors have all of this to deal with, not just for that one client, but for many clients. And when you look at a month like, March of 2020, advisors were trying to take advantage of the harvesting opportunities, but it becomes more difficult, when, let's say, the global market or the domestic markets are negative for a 30-day period, and advisors need to start forcing trading activity across 100 accounts. It becomes a hard task to manage. But when you start to look at a year like 2022, right? This, you started the question off with, we didn't have 1 month of market volatility. We started the first week of the new year negative, and then we literally have not looked back, right? So not to mention that month over month, with the exception of, I think, like maybe 3 months, each month has finished lower than the prior month. So if we take into consideration that in 2020, during the pandemic, equity markets, both domestic and international, were balanced off for a client's portfolio, which would have been a well-diversified model that the advisor delivered with fixed income. And you look at something like, the Callan chart, or, folks empathetically refer to it as the quilt chart on a monthly, asset performance by sector strategy, you'll notice that the month over month performance where fixed income in many of the months in 2020 were actually a safe haven and provided kind of positive performance in many months. But we literally had the entire adverse effect where fixed income was actually contributing to losses in 2022. So even if you are able to kind of sell a security, the question and the emotions of the question then say, do we invest the funds back in or do we leave it on the sidelines in cash? The challenging part for advisors who may even want to do tax loss harvesting is, how do I manage this? What's the expectations to manage it, right? And yes, I think the second part of your question, tax harvesting is absolutely a great strategy. And yes, it provides value and also some additional returns in a negative market to clients, but it needs to also be done and executed effectively. So one of the things that we've done is we've implemented through our custodial integrations, kind of this ability to filter down, not just to a client's security, but we can go and look at each account at that tax level in order for us to kind of provide guidance for which trades to actually create, where wash sales won't be incurred based on things that are coming in and out of the portfolio, potentially within that 30-day window of the wash sale potentially occurring. So, kind of 55 IP on at a daily basis is monitoring the accounts, is monitoring the account securities, is monitoring the tax lots, and we're trying to see whether there is or is not harvesting available. And for our models-based business, every 31 days, right outside that window, every 31 days, we evaluate, which accounts, which securities, which lots have the ability to harvest losses. We then introduce proxies that respect, the IRS wash sale rules for using a non-substantially identical security. But we also then try to introduce those proxies to, abide by what the advisor and the client are looking to accomplish, which is kind of keep tracking error down within that portfolio over time at that point as well. So, when we start to think about it, yeah, tax loss harvesting is a great strategy. Sure, in some instances, it may end up going ahead and redefining cost bases for many advisors. But when you start to think of, advisors who are planning to hand wealth over from one generation to another, I always bring up the conversation. It's better to go ahead and have a step up in cost basis within your client's lifetime rather than have the step up in cost basis happen after your client's lifetime, when those assets may also then potentially leave your business as well with the next generation. Why not get the next generation involved in the process? Introduce things like dollar cost averaging, because dollar cost averaging happens to be one of the best friends of tax loss harvesting at that point. And do so that when you're introducing that tax harvesting opportunity on a month over month basis within this client's, lifetime, you're also telling the next generation, we are doing this so that your client, your mother, your father, your grandmother, your grandfather can also start to, see value in the benefits of what they're leaving behind and gift it to you potentially with taking tax, in mind for their tax bracket, but also then to go ahead and kind of gift it to you in your tax bracket as well. So kind of take a multi-step approach to it. We also try to introduce practice management, segmentation. When we speak with advisors, we try to also introduce kind of my team's experience from the practice management standpoint to provide value and coaching to identify not just the watering hole that the advisor looked at 55 IP for, for their initial conversation with us, but we try to introduce new watering holes that they may not have thought of, but that are working in other advisors' practices.
Now, throughout this podcast so far, you've mentioned a lot of advisors are utilizing, particular model portfolios, and they kind of have more of a, call it turnkey solution to their business. But there's a lot of advisors that we work with that I know of who are really focused on building their custom models.
Yep.
Almost to a point to where it limits their growth because it's difficult to truly scale that if they're the only person in their firm that subscribes to whatever methodology they have to construct the portfolios. So for the advisors that fit that sleeve, if you will, that are very customized in their solutions, how can they look towards technology, be it yours or elsewhere, to help scale the business, but also maintain their overall, stamp of authenticity that they're looking to present to the client?
Yeah. So this concept of customization or personalization of models is actually a growing trend, right? Advisors have a great ability to identify trends and patterns and use kind of their expertise to deliver alpha or value to their clients. But creating this pattern at scale, while trying to manage the transition from a legacy strategy to, let's say, a new custom model, or taking on a new prospect and moving them into their custom strategy is extremely tricky. And when we kind of begin to introduce, the concept of inherited securities or concentration or restrictions or embedded capital gains and low cost bases, it actually becomes a lot more trickier for the advisor to actually deploy the model that they truly want to deliver to their clients, right? And in fact, I think it was in a Cerulli study as well, they said that, somewhere around 67,000 advisory practices are, in the target for models-based portfolios and models-based practices, but they don't utilize them, because it doesn't match the client's unique needs or their, unique abilities to build portfolios. So one of the things that we've done is we've introduced, a little bit of a morph to our original business model. And we realized, the goal is to let the advisor work with us to build their own portfolio. And we do so in one of three ways, while also giving them that tax smart wrapper of transitioning, automated tax loss harvesting, and tax smart withdrawals. And, there's three things that we do. First is we, help advisors, with that build from scratch concept, if you will, right? We construct a portfolio based on the advisor's requirements, and we take direction from the advisor on the models, the proxies, et cetera. And however that advisor seeks to go ahead and deploy their model, what we're trying to do on the back end is reduce the friction of ongoing maintenance, remove the friction of rebalancing or tax transitioning. As that client falls from the old model or a new prospect falls from the old model to go into that new custom model that advisor had curated for their business, right? So that's a kind of built from scratch concept. If an advisor feels that they don't want to take on, I think you mentioned it, that full onus of constructing a portfolio, we would introduce advisors to our model provider partners who would then kind of co-source a portfolio along with the advisor. The advisor has majority of the say and kind of majority of the allocation, the tilts, et cetera. But they work with the model provider to kind of determine what's the best model portfolio that fits all of the requirements of the advisor's kind of custom taste. But in addition to the ongoing maintenance, rebalancing, tax transitioning, that we provide, they then also get that full support from the model provider, their investment research team, their portfolio construction teams, and then again, the distribution partners, through the lens of internal, external wholesalers, specialists, et cetera, that firm may provide in addition to us and our team. And then the third, the kind of last version of this is there's some advisors out there that are still kind of, starting out, they're looking to create scale, but they don't have, kind of the growth in the business yet to introduce maybe a segmentation strategy, if you will. What we'll do is we'll work with them. We'll introduce financial advisors to our model provider kind of partners there, and we'll deliver multiple strategies, let's say from multiple partners. So a partner or a model provider may be a great equity provider, while another one might be a good fixed income provider. We'll load kind of both of those options on the table for an FA. Some managers may be a good active manager, and some might be a respectable passive manager. We'll load those two in addition to the prior two. So ultimately what happens is we can then help the advisor curate kind of this portal amongst all the model providers and kind of their off-the-shelf strategies, and still give the advisor that choice to provide to their client for different needs and different accounts. One client might, have 4 different accounts, and each account might have a different risk tolerance and an objective, et cetera. At least the advisor can deliver something unique to each of those models, and we're then still actually deploying our ongoing maintenance, the rebalancing, and the tax transitioning, that we kind of excel in at that point.
Now, we've talked a lot about how the tax strategy is impactful for the client. Mm-hmm. It helps increase the value proposition to them from the advisor. But if I'm an advisor, what I would be thinking about anytime I evaluate any tech solution is outside of the impact to the client. Well, what's the impact on me and my business? Does it save me time? Does it increase my revenue? Like, what is the impact on that side of things? Talk to me about kind of what the impact is on the advisor that you guys support.
That's a great question because that goes back to practice management, efficiency, scale. But let me take that response in two parts. Our pride and joy, if you think about it this way, is the results we ultimately deliver to our clients, the end consumer, right? So if you think of 2022, the tax savings we've delivered through September for our end clients is higher than what we actually produced in 2020 for the entirety of the year. Now, if I take a step back, let me just define tax savings, right? Versus kind of what's out there in the industry of tax alpha. Alpha is kind of that excess performance, above and beyond a benchmark. We're not using a benchmark to define performance. We're actually using real clients' accounts and comparing those accounts to a client's portfolio for what the client would have paid from a tax bill perspective if they did not get harvesting versus what the tax bill is or the credit is that they are getting from receiving tax harvesting. That difference between two bills is our tax savings result. So you think about it, that's potentially diluted off of the tax alpha number quite a bit. So that savings is ultimately money, a client gets to retain in their pocket, which we're thrilled about, but also it's what the advisor gets to keep in their accounts as well. And take that savings each year, you compound it, you apply a conservative rate of return that's, the value that the client sees, but it's also the value that the FA gets to go ahead and kind of hold on to for that long-term goal. So that's kind of one value that we, provide for our clients' clients. But then there's also the value that we provide to an FA, bringing back value of time within their business. And, when we think of efficiency from planning and trading, there's an ability that we provide, which is, in the sense of scale. Typically, when an advisor wants to make a trade, across their entire business, they're forced to plan out that trade and every FA is going to nod their head when they're listening to this, but you're forced to plan out the trade for 1 to 2 weeks before you're deciding to implement that trade. Leading up to the trade, there's kind of ample investigation that's done. You're looking at accounts, you're trying to see withdrawal schedules, you're trying to see which accounts would incur wash sales. And there's a number of other factors that kind of play into consideration here. But when the trade is large enough and the business is also large, trading then takes maybe 2 or 3 days to actually go ahead and execute. And when you're executing over multiple days, you may not be executing at the best price, as a firm compared to, many other advisors who are aggregating trades together, which is something, we try to do. So, assuming that all the trades are completed by that second or the third day, the ultimate result is you're going to have an issue. You're going to have, trade errors. You're going to have missed trades. You're going to have to start placing trade corrections, which will then further eat into the time that the advisor may have had to spend time, placing trades across multiple accounts or speaking with clients, et cetera. So now your one trade that you're looking to implement has stretched, 2 to 3 weeks, if not maybe even close to a month at that point, as kind of repercussions are being uncovered. Our approach is kind of unique to this. On our largest trading day, when a model portfolio is making a tactical change within their allocation, our advisors and our team will then be notified. And we're impacting, a custodial change or a tactical change by the custodian across hundreds of financial advisors, potentially across thousands of accounts. And kind of this marriage between automation and technology starts to kind of take shape. And we then start to introduce, the human elements of trading, et cetera, to kind of create that perfect synergy and synchrony at that point. Our typical day will be, during a large trade date, starting somewhere around 3, 4 a.m. with our trade generation system, kind of automatically starting the gears and running before, any of us are even awake at that point. And in a matter of a few hours, 2, 3 hours, the system starts to craft the trades for the day. Once the system starts crafting the trades for the day, there's this order generation process, which effectively produces tax efficient trades that are then to be delivered based on kind of the algorithm's views and abilities to say, what was the price of the markets? Where do we need to go ahead and execute at? What are we trying to do so that the client isn't getting impacted with a negative trade or a negative tax trade at that point? And we then ultimately start to deliver trade lists to advisors directly for trade list delivery, or would directly start executing trades on behalf of the advisor. We're not trying to rip and replace, we're trying to integrate. We will then directly execute trades with the custodian. Unlike an FA who's, now trading across multiple days and multiple prices, our relationship then with these custodians allows us to block trades at an aggregate to kind of provide better pricing for the advisor and the clients. And in entirety, a tactical trade, say across 20, 30,000 accounts, may take us to the better part of 2 or 3 in the afternoon on that day. So you're talking a 12-hour window versus a 4-week window. And that's what we're trying to go ahead and help scale. And I think, David, you and I were probably thinking about the same client when you teed up this question. But, we had a relationship, that has talked about, the scale that we've provided from the aspect of model delivery and trade execution and kind of their ability to then grow inorganically with several acquisitions since the launch of their partnership with us. But also mention that their advisors know the firm overall has a robust platform that could compete toe to toe for, opportunities against any advisor. The way that it was worded, I think in the email that we received when, this conversation started between the two of us is 55 IP's, technology is one of the sharpest arrows in our quiver that we have to attract new talent at that point. So we're not just helping with the scale of providing value to the clients, it's providing value to the advisor. And then it's also helping the advisor the ability to scale and then take the business to the next level as well, from that individual business that they might be managing to a larger business that they might want to go ahead and become over time.
Yeah. And so for those of you who are listening, we're taking a 2, 3, 4 week process, let's call it 3 weeks, condensing it down to ultimately 12-ish hours, which frees up a considerable amount of time to go and build relationships, develop more business, and not get stuck in the servicing of the promises that you made on the front end. So anytime you can buy back your time and leverage your time, if you reallocate that time appropriately, you can grow the business or just simply increase your lifestyle, right? Less time that you're spending in the business itself. And I want to wrap up this conversation here. And I know when we spoke previously, obviously we had a focus on how technology and tax planning has been sort of top of mind with the industry as of late. But there was also another topic that came up in direct indexing. And I know some advisors subscribe to that philosophy and that strategy. And I'm curious to know kind of your general thoughts on that. And also, if advisors currently aren't going in that direction, should they? And that's kind of how we'll wrap up this conversation, just to get your perspective on that.
When you think of kind of this advancement of technology within the financial services industry, the concept of direct indexing has actually, finally come to the everyday investor, right? Direct indexing has been around. It's been a staple with large investment firms being able to purchase individual stocks from an index to create a portfolio. But the average investor, that technology didn't exist, and today it does. And, if you think about it, fractional shares are, what has potentially made a lot of this possible. So if you think of kind of owning 0.5 shares of a security rather than owning a whole share, well, when you start to take that into consideration across the entire index, you might be able to build a portfolio of, let's say, $250,000 rather than several $1 million to mimic the S&P 500. So yeah, absolutely. If an advisor hasn't seen direct indexing kind of come to life, there's value there at that point. But the other thing is that, you have this ability with technology to now monitor several hundred investments across several hundred clients' portfolios. So an advisor gets to introduce this concept of scale at the direct indexing space. And there's many benefits to it, which again, you're not owning an index, you're not owning an ETF, you're owning the shares directly at the price that you've purchased them at. So when there is shift, like we've seen this year in market volatility, you have the ability to capture those losses. If the market's going up on a given day, and stocks are down, you might have an individual stock that might actually be further down than the entire market is. You can pull those triggers to go ahead and kind of gain the harvesting of those losses. And this can kind of not only help lower your overall tax obligation as a client, but it can then also kind of take the proceeds from the sale of, an investment and redirect them back into the portfolio. So buying a tech company and, as long as it's not substantially identical, introduce another tech company. But direct indexing portfolio may own only 300 of the 500 positions within the S&P 500. And those tax advantages, that ability to kind of monitor that portfolio on an ongoing basis now helps kind of relieve the burden of watching over hundreds of stocks, over hundreds of accounts each and every day. That involvement of technology also then removes the involvement of emotions and market timing. And it also, speaking of emotions, allows you to kind of directly invest the way that you want to invest, right? So whether you want to restrict certain positions like tobacco or, certain companies or industries, direct indexing absolutely gives you that ability to go ahead and kind of do so.
Well, Hiren, this has been super helpful for me personally to understand this space a little bit more. And I'm sure it was helpful for the listeners as well. So before we give you an opportunity to kind of direct the listeners to where they can learn more about working with you guys, one of the questions that we ask all of our guests as a way to distill a reading list for our listeners is figuring out a book that's had an impact on them. And I know the one that you had mentioned is called Playing to Win. Why'd you pick that one?
Yeah, so it's funny because I knew for several days approaching this podcast that I had to make a decision. And I was thinking, did I go fiction, go nonfiction? Did I go ahead and kind of shift towards the help learning? And fortunately and unfortunately, I think this book, Playing to Win, resulted in me going back to school. I had already got my MBA, but it went back and forced me to get my master's in innovation strategy, which, I don't see much wrong with. I've been a serial learner my whole life. I've got the 7 and the 66, the 9, 10 MBA. I've got all that stuff. But, when I was reading the Playing to Win kind of book, what really hooked me was kind of the innovation journey of Procter and Gamble and kind of what they did, right? They created a new way to reinvent toilet paper and razor blades. And, there's not many ways that you can reinvent razor blades or toilet papers. They figured out a way to go ahead and kind of do so. And, this industry isn't much different, right? If you think about it, the markets are the markets, but there's going to be innovations. And I've been a big proponent of this, which is kind of where my career progression at the beginning has gone. But I'm a big kind of believer that innovation is what's going to actually change our kind of dated industry to kind of take on what technology provides to us. And it's going through it. So the question that I kind of asked myself was, what more can I do? What more can I physically learn? What more can I do in terms of providing better solutions, better solution architecture, be a better consultant, to businesses, be a better partner to my business development team internally, my leadership team internally, by ramping our onboarding team, as we would call them. What more can I do? And I think a lot of what was uncovered in Playing to Win led to this concept that, you can take this industry that may be dated and bring it forward at that point as well. So that's where I thought long and hard about it, but Playing to Win basically came out on top with a few pros on that side of the board.
Well, it's interesting. That's one of the purposes, or the main purpose, I should say, of having this part of the podcast, because essentially, what you did is you took ideas from a different industry and trying to figure out how you can apply it to this industry. And the whole point is there's so much gold in books that have nothing to do with what we do. But if you have a strategic mind, or at least work that strategic muscle, you can figure out how to right size it. So I appreciate you sharing that.
How to make toilet paper better, right?
So if I'm listening to this show, I'm interested in the solution that you provide. I'm interested in getting time back in my business. I'm interested in increasing my value proposition. I'm interested in perhaps making a transition easier and more seamless. Where do I check you guys out?
Yeah, absolutely. So 55ip.com is kind of the best place to land. There's always this ability to ask your potential peers, your model provider partners, if they are working with us. Reach out to your custodians. Custodian relationships are kind of the key to success. Model provider businesses are the key to success for us as well. But if you do want to reach out to us directly, 55ip.com. Our LinkedIn page is also actively monitored as well. So again, 55, I as in India, P as in Patel, 55ip.com at that point, or the LinkedIn page, 55ip.
I was going to say, you almost missed your opportunity to give yourself a plug within. Love it. Well, Hiren, this was great. I appreciate your time. I know that this is a very busy time for you. in the transition of moving homes and the holidays as well. So I appreciate you setting aside some time. And again, Nick Gukin, thanks so much for making the introduction. But have a great rest of your day.
Thanks.